Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, the fundamentals of investing, part 4 in our series on National Financial Literacy Awareness Month. We're still talking about now investing, and now we're talking a little bit about bonds. When you look at it, you're thinking about debentures, IOUs. People actually can invest in bonds. You'll see corporate bonds. Maybe you like a certain company. They're AAA rated by Moody's or S&P or by Flitchcraft, whoever the actual monitoring company is. You're looking at those saying, I think that I like that because if something happens to that company, I'm in first position generally to get paid if I hold bonds. Some people like the basic interest rate of a government bond. They like US securities. They want to have investment grade bonds. So they're going to be playing in areas where the bond is at least BBB or higher to be an investment grade. They don't want to actually play anything below that. But some people say, I don't mind buying a little bit of junk bonds because the interest payment back to me is higher and I understand the risk and it's not a big piece of my portfolio. And if something went wrong in the worst scenario, I feel pretty good about it. I want to have the financial literacy to be able to make calls like this. This is why it's important, especially when you're young. You want to get a good long-term registered investment advisor that has serious tenure in our business so that they can kind of escort you and be an educator. If your registered investment advisor is not an educator, if your insurance agent is not a financial educator, you should need to find somebody else. You need to know what you're talking about. You can't always defer everything to everybody. On the nuances, maybe. But on the general understanding, you should have an education. I'm sorry to say, we don't educate people in America. We're the largest economy in the world, and we are completely devoid of good understanding of how money works and becoming good stewards of our money. So when I'm looking at the kind of bonds, it could be corporate bonds, as I've suggested. It could be US Treasury bills. It could be municipal bonds. This is where your city is starting, they want to build something and they push a bond out there. You're going to see the rating of the bond. If it's highly rated and you like the project and you think the income's good and you think the city's good for it, you can go ahead and invest in that. And remember, a lot of people buy municipal bonds because it might be federal tax-free, it might be state tax-free, it might be the municipality-free. Depends upon what jurisdiction, you may have tax advantages for municipal bonds. Just heads up as a senior, just remember that all municipal bond income, even though it might be free in certain jurisdictions, is going to be it will flow over to your Social Security provisional income test, and that test will conclude that for income on whether your Social Security will be taxed or not. So yes, it may be free, the bond itself, but the actual income off the bond is going to be calculated for Social Security purposes, and it may actually cost you Social Security benefits at the ordinary income tax level, which blows my mind on that. Now, remember, you want to look at this coupon bonds, and remember, most of the bonds we're looking at, you know, they're going to pay every 6 months or so. Dividends on stocks pay about every quarter. You want to make sure that if you have a cash flow issue and you're building a budget of revenue and bills, you want to be able to include when the coupon payments are going to be made. You want to be able to look at this on the ratings, as I've said before, maybe S&P, maybe Moody's, and track that to make sure. Remember that each echelon, AAA, AA+, AA. You'll want to go all the way down and see the rankings, the different echelons, the different levels of rankings, and see what you are comfortable with and make sure that you feel comfortable. That's why I say talk to somebody that actually knows this and you can walk yourself through it. You want to be able to look at this as a really good way to be part of what's going on in your portfolio. Bonds, it's not really an investment like stocks, mutual funds, or ETFs. And those bonds, remember, are somewhat touchy right now because the Fed is raising rates very slow, and as those rates tick up, the value in your bonds may be going down. The rate coupon stays the same, but the appreciating value may be actually depreciating in your bonds. So this is a time where it's kind of queasy why the Fed's actually adjusting rates. Now, mutual funds and ETFs. One of the basic ideas behind these mutual funds do not settle until the end of the day. So the net asset value at the end of the day. So if I say, get my money out of there at 10 a.m., it doesn't matter. It's going to stay in the market the entire day, and you can sell off your position at the end of the day. ETFs on the other side are going to be traded during the day. If you felt like the market's tanking and you just need to get out, you could call your broker up and they could sell it off at 10 a.m. and you'd be out. So you just want to make sure what you're buying when you do this. Mutual funds that are in indexing and ETFs as well, indexing have lower costs because they don't have management. For example, the S&P 500 as a mutual fund or as an ETF. I already have 500 large cap stocks in there. So I'm going to look at that and say, that's pretty diversified. Yes, on the basis of companies, but maybe not sector, maybe not exposure to certain risks. You just have to look at what you're looking for and what you have. You've already taken a risk tolerance test. Remember, we talked about this yesterday. So I want to look at mutual funds and ETFs. I want to look at their costs. Remember, I don't want to be sitting there at 65 saying, I just blew $100,000 in fees on my mutual funds and ETFs inside my 401k. I don't want to be sitting there with my IRA saying, well, look at how expensive it was. I want to be able to take care of that. If I was a young person again and knew what I knew now, I would be looking and pricing out and shopping this because it's not only performance, but it's expense. And sometimes I can get decent performance for a lot less money. So I always want to look at this. Remember, there's the expense ratio, there's the statement of additional information costs, there's cash drag, there's RIA fees sometimes if you have a broker doing this, as well as if it's non-qualified, you may be exposed to taxes, and if it is qualified, you may be paying administration costs as a 401k plan participant just to be in the plan. So you want to make sure you know your costs before you buy, and you want to be very good about understanding your propensities for risk. That's why you should take a risk tolerance test, find out what kind of investor you are, and then remember, when you're looking at ETFs and mutual funds, what is the beta risk? What could I lose in my principal? And am I okay with that? Do I have a long-term view? Should I be in mutual funds if I want in and out in 3 years? No. Should I be in mutual funds and ETFs in 5 years? Really, these are what I call mid to long-term investments. I'm looking at things like this for a good 10 years. If you can't play that game, you need to look at another alternative, because in the lost decade between 2001 and 2010, remember the market over that 10-year period, snapping that timeline, didn't make any money at all. There was it was actually a loss for that 10-year period. I need at least 10 years to play in this game, and I just gave you the worst scenario, hoping that you'll see that you need to be in a long haul thinking. If I'm in my retirement money, all of this is long haul. I want to be 15, 20, 30 years out, and I want to be able to be in the equity and maybe even the bond to kind of mix it up and play in my 401k to set money aside so when I retire, I have money that I can actually use and I can enjoy my retirement. I don't want to be living check to check. So first fact I want to know is, what's the history of the fund? What's the expense of the fund? What's the beta risk of the fund? I want to make sure the beta risk is that risk does that match up to my own personal risk tolerance? I want to start asking my broker these questions, and I want them to be able to educate me on how this works. Financial literacy in this area is the big area. Let me tell you something. We've had corrections. We've had bear markets. Then we had a black swan event, which is basically in 2008, where everything went south much faster than we've ever seen a bear market before. And so we want to make sure that we understand the kind of risk that we're involved in and how much we can put at risk to get the return. Remember, it's really important from a financial literacy point of view is not to be sitting in 2008 where certain people took about 5 to 6 years to recover from one big one-year event. So remember, all the people that were actually heading into retirement in 2009, 2010, it was a disaster. So you want to make sure that you have money aside and that you're parking money in proper places where it fits your risk tolerance and you think you have a good idea of the market and where it's going. And this is why I say you need to partner with a registered investment advisor and or a registered rep, a security he's licensed in FINRA under the SEC. You want to be able to look at this and lean into their knowledge and their experience. I want to check again. Remember, I want to vet the person I'm going to talk to. I want to make sure their broker check's good. I also want to make sure the Department of Insurance is clean. And I want to have this guy have some third-party people that really appreciate him, people that I might know and people that are substantial in the community to sign off on this person's integrity. I think coming into the market, I was in mutual funds and ETFs for a long time. I'm heading towards retirement now. I have less in the market, but I still like mutual funds and ETFs because I'm hoping that it outperforms inflation so that the power of my purchasing dollars stays strong. When you're looking at these things from a financial literacy point of view, don't just do what the guy tells you at the enrollment meeting at 401k. Ask questions. Ask the kind of questions about risk. Ask the kind of questions about expense loads in the policy. Think about this. Over 80% of many registered reps don't know the full expense loads in a mutual fund. The statement of additional information's cost alone generally supersedes the expense ratio that's written in the prospectus. And the statement of additional information cost is not required to be in the prospectus. You can find it, but you have to request it. To me, you need to know what you're doing. Remember, expenses, beta risk, and what's my risk tolerance. That's the basis for investing. Don't forget to watch our next segment on retirement funding, part 5 in our series on National Financial Literacy Awareness Month. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.